Hello class, this is chapter 5 video lecture, adjusting entries and the worksheet. So objective 1, prepare end of period adjustments. So changes occur that affect the business's financial conditions, such as equipment wearing out, prepaid insurance and supplies being used up, employees earning wages that have not yet been paid. Since these events have not been entered into the accounting system, adjusting entries must be made. So the revenue recognition principle states that revenue should be recognized when earned, regardless of when cash is received from the customer. Revenues are considered earned when a service is provided or a product is sold. Expense recognition principle states that expenses should be recognized when incurred, regardless of when cash is paid. Expenses are generally considered incurred when services are received or assets are consumed. So the matching principle requires the matching of revenues earned during an accounting period with the expense incurred to produce the revenues. It also provides the best measure of net income. It necessitates that accounts be brought up to date before financial statements are prepared. So a fiscal year is a 12-month period of time used as an accounting period. Does not need to be the same as a calendar year. Many businesses schedule their fiscal year in when business is slow. So for example, up at NAMPI, their fiscal year starts June 1st and ends May 31st. So in fact, we just got done finishing our audit for fiscal year 2019. So 2020 actually began June 1 of this past year. So that's how fiscal years go. Adjusting entry. So let's look at a couple entries from Rohan's company delivery. So during June, Rohan purchased supplies for $80. So $80 goes into our supplies account. They also didn't put on here that cash is debited because cash came out. So according to inventory of supplies, there are only $20 of supplies left on hand at the end of June. So we have to make it an adjusting entry to that. So the adjusting entry, so we're going to take $80 minus 20, which is $60 is how much we used. Not only that, but we have to expense out these supplies. So the adjusting entry on the supplies account is going to be a $60 credit, and supplies is going to be debited for $60 under expense. Keep in mind, this is our balance sheet account and this is our income statement account. So we're sending what we've used to the income statement. So that's actually what I just talked about right there. So let's see. So the balance now in our supplies account, which will be $20 again, this will go directly to the balance sheet. Oh, I already said that. So again, $60. Again, this goes to the income statement. I just said that earlier. So Rohan paid $200 for an 8-month liability insurance policy with coverage beginning on June 1. So prepaid insurance is debited for $200. Probably there was also another entry for cash that was a credit because we pulled cash out and paid our insurance. So now that June is over, we need to remove the cost of 1 month insurance. So we're going to take 200 divided by 8, which is $25 per month. So that's our adjusting entry we have to make is $25 because we have to expense it out. The insurance for that month has gone and is expensed out. So it's going to go insurance expense to debit and prepaid insurance is going to be credited. Again, expenses always go to our balance sheet. So the prepaid insurance account is going to be $175 because we made this adjustment. Again, that's exactly what it says right there in the balance, and insurance expense is going to be $25, and that goes directly to the income statement. So the next one, it says part-time employees were paid $650 on June 27th. Since then, they have earned an additional $50 but have not been paid yet. So an additional $25 needs to go in here as well. So an adjusting entry is going to be $50 to our wage expense. Don't forget, this expense account, again, goes to the balance sheet, or not the balance sheet, to the income statement. So wages payable is going to be credited for $50. So what we did was we put a payable, we created a payable, and that which is a liability, okay? So our wages expense for the month of June will be $700, and our wages payable will be $50 until we pay it. And once we pay it, more than likely, maybe we had, I don't know, a day that was in June and then a day that was in May. But the thing is, our pay periods are usually twice a month or weekly, or the first day of the month, or the 15th, sometimes the 5th day and the 20th day. It just depends on the payroll cycle. But you have to keep that in mind, that if the month ends, the pay period doesn't end. So keep that in mind as well. So again, wage expense will be $700. Income statement, this will be a balance sheet on as a liability. And this is all this is saying right there. So historical cost principle, assets are recorded at their actual costs. The cost remains on the books as long as the business owns the asset. No adjustments are made for changes in the market value of the asset. The only time you realize that is whenever something is sold. Then if you profit, and that's actually, you'll get into that in accounting 200 and later second half of accounting 200. Useful life, the period of time that an asset is expected to help produce revenues. An asset's useful life expires as a result of wear and tear or because it no longer satisfies the needs of the business. As this happens, depreciation expense should be recognized and the value of the asset should be reduced. And don't forget, asset depreciation will be an expense, so that goes also to the income statement. A method of matching an asset's original cost against the revenues produced over its useful life. There are many depreciation methods. We will use straight line method. Okay, there's double declining balance as well, but you won't get into that until accounting 200. There's another method, but I won't even talk about that as well. Depreciation expense is based on estimates of useful lives and salvage values. So we'll get into a little bit of that. Salvage value is the expected value or selling price of an asset at the end of its useful life, also called scrap value, residual value. Depreciable cost is the original cost of an asset less salvage value. So here's an example. So Rohan in previous chapters purchased motor scooters, and the estimated useful life is 3 years. There's no salvage value. That means whenever the asset is completely done and can't be used, it's going to cost nothing, and the original cost of $3,600. So that's kind of what I just talked about right there. So original cost $3,600 minus the salvage value equals depreciable cost. So 3,600 minus, remember we said no salvage value, so 36 minus 0 equals 3,600. So then you typically a useful life, estimated useful life is about 5 years. So, but let's see what this example says. Since we're trying to compute depreciation for 1 month, we'll use months instead of years. So it's 36 months. So this one is the useful life is 3 years. So 1 month is going to be $100 per month of depreciation that we can expense out. Now that we know depreciation for June is $100, let's figure out the adjusting entry. So delivery equipment, $100, and this is by the way, is called a contra account because it'll go on the balance sheet, but it's also it shows the actual value of our delivery equipment by month. So for example, we're going to do this adjustment here in the contra asset accumulated depreciation, but we're also going to do an adjustment over here as well. Depreciation is credited to this account. Oh no, this is the asset side. We're actually going to debit accumulated depreciation expense. So that should be coming up here in a bit. All right, let's see. So the book value carried on the books or the accounting records, book value, cost of plant assets minus accumulated depreciation, also called undepreciated cost. It does not represent the market value or selling price of the asset, okay? So just keep that in mind. Again, earlier I talked about it being a contra asset. Contra means opposite. Has a credit balance, the opposite of an asset is deducted from the related asset account on the balance sheet. So here's the depreciation expense delivery equipment. So $100. This will go on the balance sheet. This will go. These two up here go on the balance sheet. So objective 2, it says posting adjusting entries to the general ledger. So here's what the general ledger, here's the general journal, here's the general ledger. Okay, so these are our little accounts posting the adjusting entries. Okay, so let's see. So here's accumulated depreciation. These are actually the journal entries that were done, and these values are going on. And if you need to look at it a little bit closer, go to your book, and this will show in your book as well. So posting entries, adjusting entries is the same as posting other entries, except adjusting is written in the item column. So adjusting will be debit. They're both debit balances, so there'll be a debit and the ending balance. So it says objective 3 is prepare a worksheet. So the worksheet pulls together all the information needed to enter adjusting entries, prepare financial statements. It is not a financial statement, usually prepared as an Excel spreadsheet, is not a formal part of the accounting system. Ordinarily, only the accountant uses a worksheet, commonly in a 10-column format. There are 5 steps to preparing the worksheet. So you prepare a trial balance, prepare the adjustments, prepare the adjusted trial balance, and then extended adjusted balances to the income statement and balance sheet columns. Complete the worksheet. So heading includes name of the company, name of working paper, date of the accounting period, or the accounting period just ended. Excuse me, I had a hiccup. Step 1, prepare the trial balance before any adjustments in the first pair of amount columns. So here's what this looks like. This is an example. So here are all of our accounts: assets, liabilities, owner's equity, revenue, expenses, and this will always look like this no matter what company you're at. That's part of what the generally accepted accounting principle talks about and dictates. Okay, so they're the governing body. Keep in mind GAAP. There's also the GASB. Okay, so our adjustments are going to go on this side right here. So we did some adjustments. So earlier, right here says record the adjustments we computed earlier. A $60 debit to supplies expense, a $60 credit to supplies. So this is what it looks like. So our supplies is credited because it came down. All right, and we're also going to put in under supplies expense for $60. So there's that double entry accounting going on again. And let's see the next one. Oh wow, I jumped and did all of them. So here's our wage expense. Here's our wages payable. Here's our $25 of prepaid insurance that was expensed out. And here's our accumulated depreciation. So they're all listed. And down here at the bottom, 235 equals 235. Remember, they always have to balance. Now, step 3 is prepare the adjusted trial balance. Okay, so this is the balance before the adjustments, 370 plus or minus adjustments. So here's what this is going to look like. So 370, we don't have any adjustments, so 370 comes over here. Next one is 650. Oh, hang on, where'd it go? So again, 650 plus or minus the adjustments as well. So 650 stays there because we have no adjustments. All right, and then, okay, 800 plus or minus any adjustments. So this is going to be a minus 60. So our remaining balance is going to be 60 minus 80, which is going to be $20. Okay, so anyway, we'll go through and do all of these. Again, 36, there's no adjustment, so that's 36. There's no accumulated depreciation, so that comes here. There's no adjustments in account payable, that stays 1800. There is an adjustment in wages payable, so that becomes 50. No adjustments in capital, so that stays 2000, so on and so forth, all the way down. Once we add, again, add, subtract. Add, minus, subtract. So you have to keep this in mind, that's how this happens. Okay, so just keep the previous slides kind of indicate that on the presentation. So the adjusted trial balance columns, balance. Step 4, extended adjusted balance to the income statement and balance sheet. Okay, each account in the adjusted trial balance column is extended to either the income statement columns or the balance sheet columns. So again, income statement goes to our revenues and expenses, balance sheet are assets and liabilities, and capital and drawings. Those are owner equity withdrawals. So those are our asset accounts. There's our contra asset. There's our wages payable. There's our capital as well. There's our drawing of $150 that was withdrawn. So $21.50 goes in on our income statement and all of our expenses as well. Okay. Step 5, complete the worksheet. Okay, so $11.35. So the difference between these two right here, this is our revenue minus our expenses. That'll be our net income. Over here, our balance sheet. Now notice they don't balance. The reason why they don't balance is because of our net income, and that'll show here in a bit. And I just talked about all of this. So I'll just zoom through it. If you want to go through it, you can go through it on the presentation. So this 1015, our net income, also comes over here on 1015. And then 2150 equals 2150, 4965, and our balance sheet equals 4965. So all the work we just did completely balances. Okay, and I'll stop right here and I'll make another video for describe objective 4. Okay.